Is this thing actually on? Okay, yeah, we're good. Welcome to episode 2 of the Joinprop podcast. I am the head of content here at Joinprop, and sitting across the mic from me is my favorite freelance podcaster and resident skeptic.
Hey, I prefer listener proxy, but skeptic works too. I'm just here to ask the questions that normal people are too embarrassed to ask.
Which is exactly why you're here.
Mm-hmm.
So today, we are doing a deep dive into some internal breakdown data from the Academy.
The prop trading breakdown.
Right, the prop firm trading breakdown. Basically, we are unpacking the hidden realities of why people fail these funded account challenges. And I kind of want to just drop the biggest, ugliest statistic right up front to set the tone.
Lay it on me.
Okay, so the data shows that 90% of traders attempting a prop firm challenge fail.
Wait, 90?
90%.
90%. 90, I need a second. That is a staggering failure rate.
It's brutal. And honestly, it means only 5 to 10% ever actually pass and get funded.
That's literally their business model. Like, I'm sorry, if a restaurant gave 90% of its customers food poisoning, the health department would shut them down by noon.
Right.
But here, people are just willingly throwing hundreds of dollars at these evaluations.
Well, yeah, because the hook is that tiny top percentage.
Mm-hmm.
The 5 to 10% who do make it, they get funded with massive capital. Right. So every single person taking the test thinks, oh, I'm different. I'm the 5%.
But mathematically, they aren't.
Exactly. They aren't. Which is the whole mission of this deep dive today. We want to look at the exact anatomy of that 90% failure rate. Because, and this is the crazy part, it's not random.
Like, they aren't just getting unlucky.
No. It is a highly specific, repeatable pattern of destruction. And if we can isolate exactly how these accounts are blowing up, we can reverse engineer what the 5% are doing to actually survive.
Okay, I'm in. Let's reverse engineer it. Where do the 90% mess up first?
It all starts with the timeline, the artificial clock.
Artificial clock. Okay, what does that mean?
So to pass a standard evaluation, prop firms usually give you a profit target of like 8 to 10% within 1 month.
8 to 10%. I don't trade, but that sounds fine. Is that high?
It is. Look, to a normal person, 8% sounds completely arbitrary. But you have to map that against institutional reality. A massive hedge fund.
Right, the Wall Street guys.
Yeah, a $1 billion hedge fund is popping champagne if they hit 10 to 20% in a year.
In a year, 12 months.
A year. And here you have these evaluations demanding 8 to 10% in 30 calendar days.
Oh, wow.
So an aspiring trader who is actually really consistent, maybe they usually pull in 4 or 5% a month on their personal account, the challenge is essentially forcing them to double their normal realistic performance just to pass the interview.
Yeah, so if I'm a runner who usually runs an 8-minute mile,
Right.
the evaluation to get funded requires me to suddenly run a 4-minute mile. You're basically forcing people to sprint a marathon.
That is the exact perfect analogy. And what happens to your body when you try to sprint a marathon?
You completely fall apart, you pull a hamstring, you trip, your form dissolves.
Your form breaks down. And in trading, your form is your risk management. So traders stare at this ticking 30-day clock, and they realize their normal strategy won't hit 8% in time.
So they panic.
They panic. They start taking excessive risks. They completely ignore their own technical signals. The clock becomes the enemy, not the market.
That feels like a scam.
It's not a scam.
I'm not saying illegal, I'm saying it feels like one. They are setting you up with a goal that inherently requires you to trade like a crazy person just to hit it.
I get why it feels that way. I really do. But the firms are trying to stress test these traders. They want to see how you manage risk under extreme pressure before they hand you $50,000 of firm capital.
But the pressure is what causes the bad trading. You're testing for a trait by creating an environment that actively destroys that trait.
It's a brutal filter, I'll give you that. And that ticking clock leads directly into the second massive category of failures, the unforced errors.
Unforced errors, like
Yeah.
hitting the wrong button.
Sort of. The breakdown calls it a misunderstanding of the rules. These aren't even market forces crushing the trader. It's just administrative failure.
Give me an example.
Okay? So common violations. Exceeding maximum daily loss limit.
Makes sense. You can't lose half the money on a Tuesday.
Right. Failing to meet minimum trading day requirements.
Annoying, but okay.
And then failing an evaluation for holding a position over the weekend when it's forbidden.
Wait, what?
Holding a trade over the weekend.
Why fail someone for that? The market is closed. Nothing is moving.
Well,
So seriously, if I buy a normal stock on Friday, I still own it on Monday. Nobody kicks my door down. That rule is totally just a trap to take your evaluation fee.
Okay, hold on. Let me explain the mechanics here.
Yeah.
You're thinking about a normal, unleveraged cash account. But in a prop firm, you are trading highly leveraged instruments. Forex, indices, commodities. You might be leveraged 50 to 1. And while your little retail trading terminal might show the market as closed on Saturday.
The real world doesn't stop.
Exactly. Geopolitics don't take the weekend off. Elections happen.
Wars start.
Wars start.
Yeah.
Central banks hold emergency meetings on Sunday afternoons. So if you are holding a heavily leveraged currency pair and a massive geopolitical event happens on Saturday night,
What happens Monday?
when the market opens in Sydney on Monday morning, the price doesn't just neatly resume where it left off on Friday. It gaps.
It gaps, like it just skips a bunch of prices.
It violently skips. It bypasses your stop loss entirely. So you could open your laptop on Monday morning and your account is instantly down 15% before you can even click the mouse.
Oh, geez. Because there was literally no liquidity at the price you wanted to sell at.
None. The price ceased to exist. So the prop firms enforce the weekend rule to protect their capital from these insane tail risk events.
Okay. Okay. I concede. I take back the scam comment on that one. That's actually a vital risk control measure.
See? It makes sense when you look under the hood.
But wait, the breakdown also mentions failing for trading during prohibited news events.
Ah, yes. The news rule.
Why is that a rule? If you're a trader, isn't news when the market actually moves? Like, don't you want volatility?
You do, but news events are pure chaos. We're talking about things like the monthly inflation data or a Federal Reserve rate drop.
Right, the big stuff.
People think trading the news is about predicting if the number will be good or bad. But if you look at the actual institutional order book, right before a major data drop, it empties out.
The big banks just back away.
They completely pull their orders. They don't want to get run over either. So the market gets incredibly thin.
Okay, so what happens to the retail guy sitting at home?
He hits the buy button right as the news drops, expecting to catch the wave. But because there are no big orders to absorb his trade, he gets massive slippage.
Slippage, meaning he doesn't get the price he clicked on.
Exactly. He clicks buy at one price, but his order doesn't actually fill until 50 pips higher, right at the peak of the spike. And then the algorithm corrects, whipsaws back down, and he is instantly stopped out for a catastrophic loss.
Oh, that is brutal. It's basically pulling a slot machine lever.
Pure gambling. So the firms ban it. They want traders with a statistical edge, not gamblers. But imagine losing a $50,000 funded account simply because you forgot the inflation report was coming out at 8:30.
I would physically throw my monitor out the window.
People definitely do.
Yeah.
But let's move past the administrative stuff.
Okay.
Let's get into the actual mechanical risk management spiral, because this is how an account truly bleeds out.
Lay out the spiral for me. How does it start?
It starts with improper position sizing, which again links right back to the artificial clock.
Right. They need the 8%.
The 8%. So instead of risking their normal safe 1% on a trade, they risk 3 or 4% to try and get there faster.
But if the firm has a maximum daily loss limit of, what, 5%?
Usually 5%, yeah.
Then risking 4% on one trade gives you zero margin for error. If that one trade goes bad, your entire challenge is practically dead.
Dead in the water. But they don't just stop at one oversized trade. They compound the mistake by trading correlated pairs.
Correlated pairs, like trading two things that move together.
Exactly. But they trick themselves into thinking they are diversifying. A trader logs on, buys the euro against the US dollar, then they open the British pound against the US dollar and buy that too. Then they buy the Australian dollar against the US dollar.
Wait, aren't they just betting against the US dollar 3 times?
Yes, they've taken one massive directional macroeconomic bet, but they've hidden it from themselves across 3 different screens.
So they think they're risking 1% 3 times, but they're really risking 3% on the exact same outcome.
And if the US dollar suddenly gets strong,
All 3 trades crash at the exact same millisecond.
and when that happens, the real psychological horror show starts. Because what's the next thing on the failure list? Averaging down on losses.
Okay, averaging down. Let's talk about this because this is where I get confused. In normal investing, averaging down is just smart. Like, if I buy an S&P index fund and it drops, I buy more to bring my average cost down.
Buying the dip.
Right, buying the dip. Why is that catastrophic in a prop challenge?
Because of the leverage and the daily loss limit. In your retirement account, you have decades to wait for the market to recover. You have infinite time and zero leverage.
Right, the artificial clock again.
Exactly. In a prop firm, you have a hard stop at a 5% daily loss. So if a trade starts dropping, instead of just taking the tiny 1% loss and admitting they were wrong, their ego takes over.
They double down.
They buy more. They tell themselves it has to turn around. It's hitting a support level.
But the market doesn't care about their feelings.
It keeps dropping. And now they are losing money twice as fast. They're literally pouring gasoline on a fire to try and put it out, which leads to the absolute most unhinged behavior on this entire breakdown.
Worse than pouring gasoline.
Way worse. Removing stop losses during drawdowns.
Removing the stop loss.
Literally clicking the mouse, highlighting the stop loss order, and hitting delete while the trade is actively crashing.
Let me make sure I understand this. Removing your stop loss when you are actively losing money.
Right.
That is like taking off your seatbelt mid-spin out because you're stressed out by the idea of crashing.
That is exactly what it's like.
It guarantees the worst possible outcome. Why would any rational human being do that?
Because to the human brain, the stop loss represents realized pain. As long as the trade is open, even if it's bleeding cash, it's just a floating loss. It's not permanent yet.
There's still hope.
Right. Irrational, desperate hope. The price gets dangerously close to their stop loss, their heart rate spikes, the cortisol floods their system.
And they think, if it just hits my stop loss and then reverses, I'll be so mad.
Yes. So they drag a stop loss a little lower just to give it room to breathe.
And then it drops more.
Always. And now the loss is so big that accepting it would mean failing the entire challenge. So they just delete the stop loss altogether, close their eyes and pray. They stop being a trader and become a passenger in a crashing car.
Taking the seatbelt off.
Taking the seatbelt off. And this perfectly transitions into the next part of the breakdown, the mental breakdown. The difference between trading on a practice demo account and trading the live evaluation.
It's just a totally different physiological state.
Night and day. The performance anxiety manifests as total erratic behavior, hesitation on valid setups, overtrading, and what the data calls strategy abandonment.
Strategy abandonment.
Yeah. The breakdown specifically notes that many failing traders completely lack a rule-based plan and cannot articulate their entry or exit criteria.
Okay, I have to stop you there because that makes me genuinely annoyed.
Why?
Because why are they taking a high-stakes prop challenge if they don't even have a plan? That is so stupid. That feels like showing up to the bar exam having never opened a law textbook.
I hear you, but
You're paying hundreds of dollars and you don't even know your entry signal.
Mark, it's not that black and white. It's not that they never knew it. Most of these people have spent months watching YouTube, back testing, trading on demo accounts. On a demo account, they could easily explain their moving average, crossover, whatever.
So they do have the textbook.
They have it. They probably make flashcards. But the acute performance anxiety of the actual evaluation just completely erases their discipline. In the moment of execution, the plan vanishes.
Fight or flight takes over.
Exactly. You see it in the hesitation versus overtrading dynamic. Those sound like opposite problems, but they're the exact same fear response.
Break that down. How are they the same?
Okay, so a trader sees a perfect setup, the
Yeah.
exact one they practiced 100 times.
Mm-hmm.
But now it's real money, and they freeze. They think, what if this is a fake out? What if I lose my first trade?
Flight. They hesitate.
Right? They sit on their hands. They watch the trade play out perfectly without them. They leave money on the table.
Oh, that has to sting. Watching your thesis be right, but you were too paralyzed to act on it.
It stings so much that it instantly triggers the fight response. They are furious at themselves for hesitating, so they feel this frantic need to make up for the missed opportunity.
So they start forcing trades.
They jump into the market when there is no setup at all, pure noise. They start overtrading to chase the profit they missed 20 minutes ago.
So when the data says they cannot articulate their entry criteria, it's not because they are uneducated. It's because under the pressure of that ticking clock, their criteria just dissolved into gut feelings and panic.
The cognitive load is just too high. If you ask them on a Sunday afternoon, they could draw their strategy on a whiteboard perfectly. But ask them on a Wednesday morning while they're in a drawdown.
Their mind goes blank.
Completely blank. Which is incredibly sobering, really. Because it means the biggest threat to passing isn't the market makers or the algorithms.
The biggest threat is your own brain betraying you.
Exactly. Which brings us to the survival guide. How do the 5 to 10% actually survive this gauntlet?
I was hoping we'd get to the good news. What is the blueprint for success?
It's basically a masterclass in behavioral control. Master the rule books before trading begins. Implement hard stop losses on every single trade. Maintain realistic daily profit targets. And expect multiple attempts before success.
If we map those back to the failures we just talked about, they are direct antidotes.
100%. Master the rule books. That solves the unforced errors.
Right. They automate their discipline. They know exactly when the news drops. They have an alarm on their phone for Friday afternoon to close their trades.
They remove the administrative cognitive load entirely so their brain can just focus on the charts.
What about the hard stop losses?
That's the seatbelt. And I mean a hard stop loss, not a mental stop loss where you tell yourself you'll close it. A physical order in the software that closes the trade automatically.
So you literally cannot panic and delete it.
Exactly. It takes the decision completely out of your emotionally compromised hands.
Yeah.
The successful traders accept that taking a 1% loss is just the cost of doing business. It's inventory shrinkage.
Wait, inventory shrinkage? Explain that analogy.
Think about a grocery store. The manager expects some apples to rot, or a carton of milk to get dropped, or even a candy bar to get shoplifted. It's written into the business model as shrinkage.
Right.
A professional trader expects some setups to fail. It is a statistical certainty. You don't burn down the entire grocery store because someone stole a candy bar.
I love that. You don't burn down the store over a candy bar. You just log the loss and move on to the next customer. Okay, what about the realistic daily profit targets? That has to be fighting the artificial clock.
It's the ultimate weapon against the artificial clock.
Yeah.
The failing trader looks at the 8% monthly target and tries to get half of it on day one.
Swinging for the fences.
Right. But the successful trader breaks that 8% down into microscopic pieces. There are 20 trading days in a month. That means you only need 0.4% a day.
0.4. I mean, that sounds so much less intimidating. Honestly, it sounds kind of boring.
Boring is profitable. It changes your entire psychology. If your goal is 0.4%, you only need one tiny low-risk trade. You hit your base hit, you close your laptop, and you walk away.
See, I feel like if I hit my target in the first 10 minutes, I'd want to keep going like, I'm in the zone today, let's make it 2%.
And that is exactly how you become part of the 90%. Greed is just the mirror image of fear. It causes the exact same strategy abandonment. The discipline to stop trading when you are up is just as critical as stopping when you're down.
Fair point. Okay, I really want to dwell on this last strategy, though. Expect multiple attempts before success. Normalizing failure.
Yes, developing psychological resilience through that expectation.
Because if you go into this evaluation thinking, I have to pass on my very first try, or I'm a complete failure, I'm wasting my family's money.
The pressure is astronomical. Every single tick of the chart feels like life or death.
But if you mentally frame it as, this is going to take me 3 tries, I have budgeted financially for 3 evaluations. How does that change the execution?
It completely relieves the pressure valve. Why do you widen your stop loss? Because you're terrified of failing the challenge today. But if you've already accepted that failing is statistically probable,
You don't panic.
you simply don't panic. A losing trade isn't an existential crisis anymore. It's just a data point. You take the loss, you journal it, and you try again tomorrow.
So the people who pass understand that the evaluation fee isn't a lottery ticket?
No, it's tuition. You are paying to learn exactly how your brain reacts under immense financial pressure. And eventually, through just raw repetition, the demo environment and the live evaluation start to feel exactly the same to your nervous system.
Your heart rate stops spiking.
Exactly. You just execute your rule-based plan mechanically, over and over again.
Yeah.
That is true psychological resilience.
Okay, let's pull all of this together because we've covered a massive amount of ground today. And the through line is just fascinating.
The 90% failure rate isn't because the market is some unbeatable puzzle.
Right. It's because traders allow artificial timelines to force them into catastrophic habits. The biggest threat isn't a sudden news event.
It's abandoning your own strategy, taking off the seatbelt mid-spin out.
So if you are listening to this right now and you are sitting at your terminal trying to pass a challenge, or maybe you're thinking about buying an evaluation, the takeaway is crystal clear.
You have to have your exact entry criteria, your strict risk rules,
Yeah.
and your exit strategies meticulously mapped out and drilled into your subconscious
Right.
before you ever face the pressure.
You cannot build the airplane while you are falling out of the sky.
You need the rule book, and you need the cold, robotic discipline to stick to it when every instinct in your body is screaming at you to break it. Well, that wraps up our deep dive into the hidden realities of drop firm trading. Next time, we're pivoting into something totally different, but equally fascinating. The hidden algorithms that dictate our daily habits and why we click what we click.
You won't want to miss that one. But before we go, I want to leave you with a thought based on what we unpacked today.
Oh, I like this. A final takeaway.
Yeah. We've spent this entire deep dive talking about prop trading, leverage, stop losses, and drawdown limits. But I want you to think about your own career, or your relationships, or just a high-pressure situation in your own life.
Okay.
Where are you currently operating under an artificial timeline that is forcing you to make desperate, emotional decisions instead of strategic ones?
Oh, wow. The artificial clock in real life.
Exactly. And more importantly, where have you silently removed your own stop loss?
That is something to chew on for sure. Catch you on the next deep dive.
Take care.